American Express beat consensus across the board for the second quarter of 2026. Revenue came in at $19.64 billion, which is a 10% increase year over year.
Yeah, a really solid beat.
And earnings per share hit 4.53, up 11%. Looking ahead, management raised their full-year revenue growth guidance to a flat 10%.
Right, that's up from their prior 9 to 10% range.
Exactly. And they reaffirmed EPS guidance of 17.30 to 17.90. Shares ticked up slightly in early trading on the beat, but, beyond those headline numbers, there's this massive structural shift happening under the hood.
Oh, absolutely. It's fascinating.
It really is. I mean, imagine the most exclusive, stodgy country club,
Yeah.
Suddenly becoming the biggest trend on TikTok. That is exactly what is happening to American Express right now. So today we're putting on our financial analyst hats to crack open this Q2 earnings report and really dive into this. We want to find out why Gen Z is keeping a legacy financial giant alive and extract the critical signals for you, the retail investor.
Right, because we have a nearly $20 billion quarter here.
Exactly. So let's unpack this. Where exactly is this massive influx of cash actually coming from, especially in such a volatile economic environment?
Well, it's being driven by a very specific consumer demographic, one that honestly refuses to stop spending on lifestyle and experiences.
Yeah.
If we look at the underlying metrics, overall billed business...
Which is the total dollar value of transactions processed on their network.
Right, exactly. So overall billed business was up 9%, and that is on an FX-adjusted basis.
Let's clarify the mechanism of that adjustment for a second, just so we're all on the same page.
Mm-hmm.
When management says FX-adjusted, they're stripping out the noise of currency exchange rates.
Yep.
Like, if the dollar's really strong, international revenue looks weaker on paper when you convert it back to U.S. dollars.
Yeah.
So adjusting for it shows us the true organic volume of cards actually being swiped.
That is the exact mechanism, yeah. It isolates the actual human behavior from, macroeconomic currency noise. And management explicitly noted this 9% real volume increase is the highest growth rate they've seen in 3 years.
Wow. In 3 years.
Yeah. But to understand the revenue beat, the focus really has to be on who is swiping those cards in the U.S. consumer services segment, because that segment grew 11% overall.
Right, and this demographic shift is probably the most counterintuitive part of this entire earnings release.
It really is.
Millennials and Gen Z are the primary growth engine here. They generated a 14% year-over-year increase in billed business. This younger cohort now makes up 31% of total U.S. consumer billed business.
Which is huge.
It is. Compare that to Gen X, who grew 10% and make up 36% of the total, and baby boomers, who only grew 5%.
And if you look at the specific products they're adopting, it tells an even more compelling story. The U.S. Platinum portfolio, which, carries a staggering annual fee.
Almost $700 now.
Right, $695. That card is now the fastest growing card in their U.S. consumer business.
I got to challenge the long-term viability of this, though. You don't typically associate a $695 annual fee premium travel card with 20-somethings who are just starting their careers.
No, normally you wouldn't.
So, are these younger cohorts actually profitable for American Express? Or are they just churning through cards? Like, are they grabbing the 100,000-point sign-up bonus, taking a free flight to Tulum, and then just dropping the card before the second annual fee hits?
It's a fair question, but CEO Stephen J. Squeri addressed this directly, and the financial models actually back him up. What's fascinating here is he specifically highlighted that millennials and Gen Z represent greater lifetime value.
Greater lifetime value.
Yeah. From an analytical standpoint, this is a calculated customer acquisition strategy. It's based on the math of compounding spend. You have to remember, Amex operates a closed-loop network.
Right, unlike Visa or MasterCard.
Exactly. Visa and MasterCard just process payments for other banks. But Amex is both the network and the issuing bank, so they keep the entirety of the merchant discount fee, but they also take on the customer acquisition cost.
Got it.
By capturing this demographic early, right before they enter their peak earning years, Amex basically locks them into a very sticky ecosystem.
So they're betting that the friction of leaving the ecosystem outweighs that high annual fee. But what are they actually buying? Because if they're putting basic living expenses on a premium card, the math doesn't work out for the consumer.
But we can see exactly where the money is going, and it proves the thesis. U.S. travel and entertainment, so T&E spend, is up 13% year over year.
Wow.
Yeah. This younger cohort is utilizing the core benefits of the Platinum portfolio. the lounge access, hotel credits, dining reservations.
Right.
If you extract maximum value from those travel benefits, the card effectively pays for itself, which mathematically reduces the incentive to churn.
Okay, that makes sense. It paints a very rosy picture for the domestic consumer. But I'm looking at the global and commercial data in this report, and the growth is, well, it's fractured.
It is definitely a tale of two cities.
Yeah. International card services billed business was a massive bright spot, up 13% FX adjusted. That was driven equally by international consumers and international large corporations, both up 13%.
Mm-hmm.
But then we hit the domestic business segment. U.S. commercial services lagged severely, coming in at a really sluggish 5% growth.
Well, yeah, and both U.S. small and medium enterprises and U.S. large and global corporations, they both sat at that exact same 5% mark.
So what does this all mean? I'm genuinely confused by that 5% commercial growth. I mean, in a macroeconomic environment with sticky inflation, shouldn't corporate spend naturally be inflating too?
You would think so, yeah.
If a company's raw materials, software subscriptions, travel costs are 4 or 5% more expensive this year, a 5% growth in billed business means their actual purchase volume is completely flat, if not shrinking.
Right.
Are they losing corporate clients to competitors?
Well, they aren't necessarily losing clients. The clients are just behaving defensively. Businesses face a very different reality than the premium consumer right now. Sustained higher interest rates make debt expensive, supply chains are still nuanced, and there's just a general caution about capital expenditure.
Oh, absolutely.
CFOs are tightening their belts on procurement and halting non-essential corporate travel. Meanwhile, the premium consumer is engaging in revenge spending. They're prioritizing lifestyle over savings.
Sure, but a 5% growth rate is a drag on a company guiding for 10% overall. How does a massive financial institution counter a systemic slowdown in corporate spending?
By fundamentally changing what the credit card does. If you read the business highlights in the report, Amex just piloted a new expense management platform for an initial group of middle-market customers.
Wait, really? They're essentially building a software company inside the bank.
Basically, yeah.
Is that a strategic pivot or just a desperate attempt to hide the fact that their core corporate travel business is stagnating?
I wouldn't call it desperate. It is a highly calculated attempt to build a defensive moat. They are offering integrated software solutions alongside the credit line. Think about the friction inside a mid-sized company.
Okay.
If American Express can seamlessly integrate their expense tracking directly into a company's internal accounting and HR software, the physical credit card becomes an indispensable operational tool.
Oh, I see. It becomes entrenched in the company's daily workflow.
Exactly. Even if that company reduces its overall travel budget, they are highly unlikely to rip out their entire accounting infrastructure just to switch to a different corporate card provider.
Right. That shifts the conversation from acquiring new volume to locking down the volume they already have.
Precisely.
But I want to pivot to the P&L statement for a second, because maintaining this entire ecosystem is incredibly expensive. To generate that 9% overall spend growth, American Express is burning cash to keep card members engaged. Total expenses for Q2 were up 12% to $14.48 billion.
Yeah, and the critical line item for you to isolate as an investor here is variable customer engagement, or VCE.
Yes. Here's where it gets really interesting. VCE expenses surged 17% year over year to $8.75 billion. To put that in perspective, variable customer engagement now consumes 44.6% of their total revenue.
It's massive.
Nearly half of every single dollar that comes through the door goes immediately back out to pay for customer perks.
We really need to explain the mechanism of VCE because it's not traditional marketing.
Right.
It's like a casino offering free luxury hotel suites, high-end dinners, and show tickets to their high rollers. Yes, the suite costs the casino real money to maintain. That is the variable customer engagement expense.
Okay, I like that analogy.
But it mathematically guarantees the player stays inside the building. They engage with the ecosystem, and ultimately they generate more revenue on the floor than the suite cost to provide in the first place. For Amex, VCE covers the Platinum Card refresh, the cost of airport lounges, and crucially, the redemption of membership rewards points.
Let's drill into those points for a second. The report highlights they just enabled points redemption for U.S. card members checking out directly with Apple Pay.
Yeah, huge move.
They're removing all friction from spending rewards. But from an accounting perspective, when a customer redeems a point, Amex has to recognize that as an expense.
Exactly. When you earn a point, it sits on Amex's balance sheet as a liability. When you spend it through a seamless integration like Apple Pay, The liability is cleared, but it hits the expense line immediately.
Ah,
That frictionless redemption is what's driving the 17% surge in VCE.
and they're stacking lifestyle partnerships on top of it, too.
Mhm.
Like, they became the official payments partner of Fanatics worldwide. They announced a global partnership with All Accor, integrating with 45 luxury hotel brands like Fairmont. And they proposed the acquisition of The Fork, which is a European restaurant booking platform with 50,000 restaurants. It's like building a walled garden but having to pay increasingly premium prices for the fertilizer to keep the plants blooming. At nearly 45% of revenue, at what point do these rewards cost too much? Like, when does the cost of the casino suite outweigh the revenue from the high roller?
Management is acutely aware of that tipping point. If you dig into the cautionary note regarding forward-looking statements, they explicitly flag the risk that their value propositions might cease to be cost-effective.
Wow, okay.
I mean, they are expanding their global lounge collection at a massive pace, and rent and operational costs for premium airport real estate are skyrocketing.
So they know the treadmill is speeding up and they basically have to run faster just to maintain their current margins.
They do. But the empirical data proves the strategy is currently yielding unparalleled results. The report notes they ranked #1 in the J.D. Power 2026 U.S. credit card mobile app and online satisfaction study.
Number one.
You do not achieve that level of customer satisfaction, nor do you grow millennial spend by 14% without delivering tremendous value. They are modeling that the lifetime value of these deeply entrenched, highly engaged customers will outpace the raw expense of the rewards.
Right. Well, the top line is undeniably strong, but let's look at the actual banking mechanics under the hood. Amex isn't just a tech platform or a rewards club. They are a bank taking on immense credit risk.
Yes, absolutely.
Pre-tax income is up a healthy 15% to $4.07 billion, and their return on average equity sits at an impressive 36%.
We should definitely pause on that 36% ROE because it requires some context.
Yeah, why is 36% impressive? What's the baseline we should be comparing that against for a large financial institution?
A typical, well-run traditional commercial bank generally targets an ROE between 10 and 15%.
Wow. Okay, so 36 is massive.
Exactly. Achieving 36% means Amex is exceptionally efficient at using the capital their shareholders have invested to generate profit. It proves that the premium fee model, combined with the merchant discount revenue from their closed-loop network, is just a cash-generating machine.
Right.
But as an investor, your primary concern shouldn't just be the upside. It has to be the downside protection, which brings us to credit quality.
Yeah, and provisions for credit losses actually decreased 23% year over year, dropping to $1.1 billion. The earnings report notes this was primarily driven by a reserve release in the current period compared to a reserve build in the prior year.
Right.
Let's break down the mechanics of a reserve release for the listener, because it honestly sounds like accounting magic.
It kind of does. But think of a credit reserve like a mandatory rainy day fund that banking regulators force institutions to keep. When Amex expects the economy to take a downturn and anticipates more people defaulting on their credit card bills, they're required to take cash out of their operating capital and lock it in this rainy day fund. That is a reserve build, and it hurts earnings.
But the economy didn't crash the way analysts feared.
Precisely. Because fewer people defaulted than Amex conservatively projected, regulators allowed them to take money out of that rainy day fund. That is a reserve release.
Got it.
It flows back onto the income statement, which artificially boosts profitability for this quarter.
But the underlying credit metrics actually support the release, right? The net write-off rate, which is the percentage of debt they've completely given up on collecting, was 2.0%, which is totally flat year over year.
If we connect this to the bigger picture, that is probably the most bullish data point in the entire report.
Really?
Oh, yeah. Maintaining a flat 2.0% write-off rate while simultaneously growing billed business by 9% in an inflationary environment, that indicates best-in-class underwriting. They are successfully acquiring millennials and Gen Z customers who spend aggressively but crucially possess the cash flow to actually pay their bills at the end of the month.
And the structural foundation supporting that lending looks bulletproof too. They reported $216 billion in deposits, which makes up 73% of their total funding.
Yeah.
And 92% of those deposits are FDIC insured.
That funding mix is a massive competitive advantage.
Let's explain why that is. How does having 73% of their funding come from customer deposits insulate them compared to a financial institution that, say, relies on the debt markets?
Well, if you don't have deposits, you have to borrow money on the open market by issuing bonds to fund your lending.
Right.
In a high interest rate environment, the debt market might demand a 6 or 7% yield to buy your bonds, but deposit funding is incredibly cheap and sticky. Amex pays a relatively low yield on consumer savings accounts and uses that cheap capital to fund credit card loans charging 20% or more. The spread between what they pay depositors and what they charge borrowers is their net interest margin. And a 73% deposit base virtually guarantees that margin remains wide and stable, regardless of broader bond market volatility.
That makes total sense. They also reported their Common Equity Tier 1, or CET1 ratio, at 10.4%.
The CET1 ratio is basically the ultimate measure of a bank's financial strength. It compares their core equity capital against their total risk-weighted assets. Regulators require a minimum of 7% to ensure a bank can absorb a severe financial shock without failing.
So sitting at 10.4% puts them right in the middle of management's 10 to 11% target range and miles above the regulatory danger zone.
It is a fortified balance sheet, but a strong balance sheet doesn't make a company immune to external shocks, which is why the risk disclosures in this report really require your attention.
All right, let's talk about those looming shadows. The forward-looking statements detail several unquantifiable macro threats. They highlight the usual suspects, of course inflation, fluctuating interest rates, and the unknown variable of AI adoption disrupting the payments landscape.
Sure.
But the regulatory environment seems far more threatening. They specifically detail severe regulatory initiatives regarding pricing for card acceptance, interest rate caps, fee caps, and broader network regulation.
Yeah.
If Amex's entire model is based on charging merchants higher discount rates to fund premium consumer rewards, how catastrophic is a regulatory cap on those fees?
Honestly, it's the single biggest threat to their business model. Because Amex operates that closed-loop network we discussed, they have superior data visibility and immense pricing power over merchants. Merchants paid a premium to accept Amex because they want access to those affluent, high-spending cardholders.
But if the government steps in and mandates that credit card networks cannot charge merchants more than a fixed low percentage per transaction, the entire math equation of the variable customer engagement expense collapses.
It would force a severe recalibration. I mean, if merchant revenue drops artificially, Amex has less capital to fund the casino suites, the lounges, the points, the dining credits.
Right.
However, the fact that management confidently raised their full-year revenue guidance to 10% suggests they do not foresee any material impact from these regulatory actions manifesting in the back half of 2026.
Okay.
They are betting that their premium brand positioning and affluent customer base provide enough leverage to weather any immediate political scrutiny.
So to synthesize all of this for you, the retail investor, American Express is delivering a masterclass in demographic transition. They are generating undeniable, strong top-line growth by capturing younger, premium consumers and securing massive international spend. And they're underwriting this growth with stellar credit quality evidenced by that flat 2.0% write-off rate and supporting it with a highly insulated, deposit-heavy balance sheet.
But the friction really lies in the cost of loyalty. They are burning massive amounts of capital, nearly 45% of their revenue, just to keep these new cohorts engaged with software acquisitions and exclusive lifestyle partnerships.
Which leads us with a final thought to consider as you model out the future of this stock. We discussed American Express pivoting into the B2B SaaS space by offering integrated expense management software to middle-market clients.
Right.
If they successfully transition from a pure credit provider into an indispensable corporate software platform, does their future competition stop being legacy networks like Visa and MasterCard and start being massive tech giants like Salesforce, Stripe, or SAP?
Exactly. And if Amex is effectively buying fierce loyalty with an ever-increasing array of rewards, what happens when the next generation demands even more just to stay? Are we witnessing an arms race for wallet share that ultimately crushes long-term margins? If they're fighting a two-front war-battling chase for the Gen Z consumer and tech giants for corporate software dominance, can even a 36% ROE sustain that kind of warfare?
Follow the show for daily earnings coverage to stay ahead of the markets.